let's go to Investing University. We are going to dive straight into Investing University, where we talk about how to grow our wealth in a fundamental, solid way. When I talk about fundamental, I'm not talking about just fundamental analysis, but really fundamentally the techniques used in investing. Disclaimer, I'm not a licensed financial advisor. This is not financial advice. I'm not recommending you to buy or sell anything. Please really do your own homework or seek the advice of a financial advisor whom you know actually knows what is happening. So test the financial advisor. Not all financial advisors, I mean, they're qualified in terms of license, but in terms of knowledge, I've seen terrible ones. So they are not all made equal. If you're a financial advisor, please, I mean, I think you agree with me that not everyone is equal, correct? You are the good one if you're listening to this. Okay. Anyway, homework one, we talk about setting up your brokerage account, and we talk about having your shopping list, companies that you want to buy. And homework two, we talk about reviewing income statements of the companies you want to invest in. Today, let's talk about the balance sheet. Now, this is a very, very powerful, I would say, like a financial statement. And why is that so? You'll understand that in a moment's time. So now balance sheet is amazing, you know. You know why? Because when we choose to buy a share of a company, example I used was Walmart. So I'm going to continue this example. Walmart, if you're buying Walmart, you need to know what you're buying. Example, let's say you want to buy my company, you want to buy Next Level, and you come over, you got to check what you're buying, right? I remember watching a Taiwanese show that's so funny. It's really funny because, right, this particular company, they wanted to buy over another company. So okay, let's call them A and B. A wanted to buy over the company of B, and A is a tyrant. A is someone super rich. He wants to bully B, and then B, he owns a small little company in this nice little building, and they are really, I can't remember what the business was about. So when A actually spent the money to buy over the company of B, right, he signed the documents and he said, okay, you're going to hand over your company to me on this date. So on that particular date, A went into the B company's office and say, now get out of this office because I own your company. And B laughed at him and said, oh, what do you mean by that? This office is a rented office that I rent from someone, and now the rent has has changed to a new company, which is my new company. The old company has stopped the lease already. So you get out of this office. So A was in a shock. He said, you mean I didn't buy over this office? You mean I just buy over a company that's just renting an office? and B actually laughing off. So it's important to know what you're buying when you buy over a company. I don't know whether you all watched that Taiwanese show. If you did, tell me the title of it. I can't remember what is it. Okay. Anyway, come back to here. Let's talk about Walmart. When we talk about Walmart, when we want to buy a share of Walmart, we want to know what we are buying. In case you don't know what Walmart is, it's a super big supermarket. Did I use the word super twice in a sentence? My teacher is going to feel very sad, my English teacher. Okay, but anyway, when we talk about balance sheet, you look at the balancing scale. On one side is all the assets, okay? And on the other side, it is the liabilities and the equities. Now, this is how I like to look at it. Now, Walmart is a super big supermarket. It's a supermarket, okay? And this supermarket, right, they have assets to run their business. So every day they sell goods and services, right? Not services per se. Okay, they sell goods like Coca-Cola, they sell your groceries, they sell bicycles. So I think of the biggest supermarket, you times it 1.5 times is probably like Walmart, or maybe it is Walmart you're thinking of. So now for Walmart, they have assets, they have cash. Okay, it's a bit small. Later I'll go into details. Okay, you have cash, you have inventories. Inventories is like all your groceries and things like that. You have all this. You have property. Okay, for example, your supermarket, you need a property. You have long-term assets and quite a number of these things. Now all these are things that you need to run your business. Does it make sense? You need to have cash to run your business. You need to have inventory to run your business. So all this allows you to run your business. If you want to set up a Walmart, you likely need assets like inventory. You need cash. You may not need it at this scale, like they have a $9 billion worth of cash. Maybe if you want to start a small little mart, okay, but you do need cash. You do need all this. Now, these assets to run the business are financed. Okay, how do they actually get the money to actually pay for all the like inventories and pay for the property? Is either financed through equity. Equity means, hey, be my partner, come and join me as an investor. Okay, so people who invest into the company, or they are financed by liabilities, which is loans. Loans is example, they can actually go to Coca-Cola and say, can I take like 1 million bottles of Coca-Cola first and pay you later? So it's like taking a loan. They borrow the Coca-Cola, okay, or they buy the Coca-Cola and they will pay the Coca-Cola later. But it's the liability. They can also go and get a bank loan, okay, like a long-term debt, financing loan, or even when they buy their property, there's a certain loan. Okay, so this is a liabilities that is like a loan. Investors is like capital equity. So when you add up the amount of liabilities plus equity, this gives you enough money. Here, 252 billion, 252 billion to finance your assets. Okay, so this is why it's called a balance sheet. Assets equals to liability plus equity, because you need liabilities and equities to finance your assets. So this is how I look at it. If you are a professional accountant, you think I'm wrong, feel free to comment below and I would love to hear your perspective. Okay, so this is from an investor's perspective. Now, let's take a look at the line item. So by the way, first of all, how do we find out where's the balance sheet? Okay, this is what they call a balance sheet, but where do we find the balance sheet? So let me bring you to Google and you can search for Walmart. How do I search for this? Walmart balance sheet or Walmart financial statement, annual reports. Click on this, they will have financial reports, annual reports for you. Click on the annual report, you can go into the PDF file, search for balance sheet. So you can see that's where I get the assets, I get the liabilities, I get the equities. I mean, I don't get it, but I see a snapshot. So first thing first, they say as of January 31st. This is January 31st, 2025. Okay, I think it should be 2025. Okay, because it's the latest balance sheet. So it is a snapshot, because you must understand, every day the cash comes in and comes out. People are still paid. Every second right now, people are spending money at Walmart. So this cash is like, okay, pause for a moment, let me calculate them. It is that one split second. So everything changes. But as of now, you can see what is the amount of cash you have. It's a rough gauge. It's a rough gauge. Okay, so it's very important not just to look at now. Okay, as 31st January, or it's 2024. Okay, you can compare to the previous years to see whether from last year until now, is there a growth in terms of cash and cash equivalent and so on. Okay, I'll be explaining some of these key items here. This is the way to find the balance sheet. Now, another way to look at it is from Jita. So in jita.com, you can sign up for a free account. You can search for Walmart. This is what we did last week. And we have seen Walmart's income statement. So Jita is a free website. It gives you a consolidated 10 years results. So you click on financial. Okay, 5 years result actually. But we can look at the 10 years summary later. And once you're in the financial, click on balance sheet and then click on annual. So you can see for the past 5 years, how is the situation of Walmart growing? Is their assets increasing? Are their assets increasing? Is their assets? Okay, never mind. Sorry, my English teacher. Okay, so anyway, coming back to here, 2020, you can see they have cash of 9 billion. How do I know billion? Because here is in millions of USD except for per share item. So 9,000 million is 9 billion. 17 billion, 14 billion, 8 billion, 9 billion. So this is the amount of cash. Now, is this a concern? Later, we will dive a little bit deeper into it, because sometimes they use the cash for certain things, or certain period in time, they have more cash for certain reasons. So now, this is what we have, the list items. You can look at it on Jita, or you can look at it in the balance sheet. Jita is pretty good because I can see 5 years straight as compared to only 2 years in the, I would say, the annual statement. Okay, so the annual reports. Now, let me share with you the line item very quickly. In fact, the slides, I put all this in. I will put the slides into the Telegram group. You can go and take a look at it. You can take a reference for it, okay? So first we talk about assets. Now, assets are things that they need to run their business and things that they own. So these are also things that, example, you have assets like car, you have assets like a house. All these are yours that you can actually sell to make money or to bring in money, right? So example, they can sell away all this, and this will be the total cash they have, total assets. $252 billion. Okay, if they sell everything. So their bank will have $252 billion. And later we talk about it, they have to actually pay off their liabilities, pay off all their loan, their bank loan, how much they own Coca-Cola. And this is the total liabilities. 252 billion minus away this is how much the total equity has. Total equity, 90 billion, belongs to shareholders. Okay, so when it belongs to shareholders, that means that if, let's say, the company is to dissolve means that if they sell away everything, okay, we're not going to run Walmart anymore, I'm tired of it, I'm going to sell away everything that I have, sell away all my inventory, sell away all my property, I'm going to pay off all my liabilities, pay off all my suppliers, pay off all the bank loan, I'm going to return all the money to the shareholders. This is the amount of money that they will be paying us back. Got it? This is the amount of money. Okay, so now let me share with you some key things. So in asset, let's take a look at asset. Okay, it's super interesting. What are we buying when we buy Walmart? So we are buying a company with this asset. An asset is divided into two portions. We can see current asset and longer term asset, long-term asset. So current asset and long-term asset. What's the difference between current and long-term? So current assets are assets that you can liquefy. Did I use the correct word? So turn into cash. You can actually sort of turn them into cash within 12 months. Okay, so what you can see example property is not under current asset, it's under long-term asset. Hey, but Sean, I'm good at selling property. I can sell them within 2 weeks. Well, I understand that. Some of you are very good property investors and also maybe property agent, but I'm talking about on a accounting basis. Okay, property is typically not something that you take and use as a cash. Okay, so these are things that will be liquid or used up within 12 months. So some of them short-term investments, okay, things that like stocks, bonds, trading assets, again, they actively buy and sell to make a profit. So let's see. Interestingly, Walmart, okay, they do not have really short-term investment or trading assets. You can see that. They don't have this. Cash and cash equivalent. These are money that is in their bank or in their cashier. So it can be even fixed D. Why do they say cash and cash equivalent? So maybe fixed deposit. Well, it's not really something you can access immediately, but if you want to, within 12 months, within 3 months, you can access them very quickly. Okay, so these are assets. So accounts receivable are things that people owe you. They owe you money. They have to pay you. So you can see example of accounts receivable, customers that own the company for products and services. Hey, wait a minute. You see, like, how come? Because people go to the supermarket, they pay immediately. Why do they owe money? Well, you must understand Walmart has this thing called a Walmart credit card. I think with Credit One company, I'm not sure whether it's still ongoing, but there are customers who still have not fully paid yet. Okay, so you can see accounts receivable about 8 billion. Oh, there's a lot, man. Okay, so well, we talked about credit just now, right? About people owning credit card debt. So this is what's happening. Now, next portion, inventory. Inventory is basically their groceries, their eggs, their chicken, their like bicycle, things that they put into their store. They are holding that $54 billion. Okay, prepaid expenses. Again, I have it all here. Hang on a minute. Prepaid expenses are expenses that they have already paid for. Example, rental. Maybe they pay rental 3 months in advance, and these are about 3 billion worth. So total current assets, okay, things that will be used within 1 year. You can see even prepaid expenses, like I pay for my rental 3 months in advance. Well, I'm going to use it within the next 3 months. So you can see all these are within 12 months. So if you buy Walmart, you're buying a company with all these assets. People still own them, about 8 billion. They have 9 billion in cash. They have inventory of 54 billion. In case the company closed down, you buy over the whole company, you can eat 54 billion worth of groceries. But I don't know the perishable. Some of them may just be expired within the next few weeks, right? Okay, but you get the idea. You get the idea. You have this, a company that owns all this. Now, let's look at the non-current assets, long-term assets, or sometimes they call it non-current assets. So non-current, long-term assets, they are liquid from a period for more than 12 months. You will not use them within the next 12 months. So let's take a look at what they are. Number one, property, quite simple. Okay, here, plants, property, machineries. So these are basically things that, well, if you go into the building of Walmart, likely they own that building. They own $239 billion worth of property, plant, and equipment. What equipment do they have? Maybe the cashier, maybe, I don't know, the shopping cart. So every time you steal a shopping cart from Walmart, you do not pay back. Well, you're making the shareholders poorer. Okay, you get the idea, correct? Now, there's also accumulated depreciation. Now, what this means is, right, they have bought like all the shopping carts, they have bought all the cashiers, but they also know that these shopping carts will not last forever, right? Maybe this shopping cart, they can last for 5 years. So let's say they buy $100 billion worth of shopping cart. They will say, well, if it lasts for 5 years, every year, let's set aside 20 billion. We have bought 100 billion worth of it. Let's set aside 20 billion of expenses or cash to save out, to plan next 5 years later, we're going to buy more of them. So this is called depreciation, which is an expense, something that they actually set aside, a certain amount of money. They say, okay, the asset, well, when we bought it, it's worth 200 and over billion, but right now, over the years, it has gone down in value. So we're going to depreciate it. So again, this is to be very, I would say, accurate, because like I told you, assets are things that we can sell away and turn into cash. But however, my machineries, my buildings and all that, maybe the current market value is no longer worth 200 billion. It is only worth, let's say, 130 billion. Well, a lot of times, this is also understated. There's a particular accounting principles that say that if it's an asset, if it's something that belongs to you, make your balance sheet looks good, you're going to put at a lower amount. So this likely is understated, because like we know that building, although Well, let's say they bought it for tens of billions. Over the years, it may even increase in price. But usually, most companies, they do not reevaluate their companies. Typically, they don't, okay, or their buildings, okay. But some of them do, so you're going to be aware of that. But right now, you can see depreciation. It is 130 billion worth of current market value worth of their property, plant, and equipment. I hope this helps, okay. So now, next portion, long-term investments, maybe fixed D, more than 3 years, treasury bills, okay, goodwill. This goodwill is very interesting. It can be maybe even their branding, their connections with their customers, connections with their suppliers. All these are things that they assess to be things that you can't really measure. Now, another possibility of goodwill, when you see 28 billion, wow, there's a lot, man. What is it? It may be something that they actually buy. Okay, they buy another company. Example, they buy a petrol station. And that petrol station, okay, let me try to explain this. So goodwill. Let's see, where is it? So when we talk about goodwill, right? So example, when they actually buy a petrol station, and that petrol station, we should see quite often, right? Like Walmart petrol station, if you are in US, petrol station is worth, let's say, $1 million. However, when they negotiate with the owner, they say, I want to buy it over, and the owner say, I'll sell it at 5 million. So when they actually buy a petrol station that is worth 1 million based on market value, at 5 million. Why would they actually pay 5 million? Because in their opinion, they say, well, market value based on their assets, based on their liabilities is worth 1 million. However, we think they can make us a lot more money. So we are willing to pay 5 million. You can see that this 5 million they pay for something that's worth 1 million, there's a $4 million in assets. So they paid an additional 4 million. They consider this goodwill. So goodwill means things that can't really be quantified. So we pay this additional 4 million. It is an asset to us. We believe that it will give us even more money. So in this 28 billion, there will be some of the like acquisition that they bought that's above market value. Okay, so this is the idea of it. So other intangibles, as mentioned just now, we talk about goodwill. Intangibles are patents, trademark, brand names, even database and things like that. So these are intangibles. So these are things that the accountants will actually go ahead and calculate a certain amount of it. Now, the next portion, we talk about loans. Well, loans receivable. So they lend people money. They don't lend people money. Okay. Accounts receivable long term, no. Nobody own them a lot of money for long term. Deferred tax. Okay. So deferred tax means that these are tax credits that they can actually get back the credits. So these are things that it is a asset to them. So when you buy this company over, assuming that you buy over the whole entire Walmart in probably a 1 year time, 2 year time, 3 years time, there'll be $1 billion worth of tax credit coming back into your company. Oh, that's cool, right? Okay, other long-term assets. Okay, these are things like, example, is there any examples of long-term asset? Okay, yeah, like here you can see they own that doesn't fall into previous category. Okay, now you have things like expenses paid for, or they are basically not goodwill, they are not intangibles, they are not plants and properties. What are other long-term assets? Probably maybe some other things that they bought. Okay, so you can see total assets. Okay, but all these can be turned into cash. 2.8 billion worth of it. So total assets, 252 billion. So there we have it. We are buying a company with all these assets that is financed by liabilities, okay, and also equities. So let's quickly take a look at liabilities. Okay, we need to know when we buy this company, what are we owing? Okay, we own these companies, but what do we owe people, correct? So liabilities, same thing. There's current liabilities, things that we need to pay within 12 months. Okay, so some of the current liabilities, accounts payable, means that money that the company owes suppliers. Let's see how much they owe. Current liabilities. Oops. Okay. So current liabilities here. Okay, accounts payable, they owe 56 billion. Dude, when you buy Walmart, you suddenly owe someone 56 billion. Okay, again, don't have to be too worried. Let's take a look at the cash. Come on, man, the cash is not enough. Okay, so you can see these are the things to take note of. Very likely, you can see the inventory is 54 billion, correct? The inventory is 54 billion, which is all the groceries. I mentioned all the Coca-Cola. I'm using Coca-Cola excessively. All the Mr. Beast Feastables, chocolates and stuff like that. It is very likely financed here. Okay, which they have to pay out in a few months' time, because this one, current liabilities, is less than 12 months. So we have accrued expenses, things that, again, they have to actually pay for it, okay, within the next few months. They are using it right now. Maybe, I don't know, electric bill or things like that. Okay, short-term borrowings, current portion of long-term debt. Okay, so again, you can see that there's long-term debt. Maybe they borrow money from bank, and this bank say you have to pay over 10 years. And for this portion, what they have to pay right now is here, current portion of long-term debt, current portion of capital leases, tax payables, All these are things that they have to pay right now, okay, within the next 12 months. So I've actually given a breakdown here, all the, I would say, definitions of it. Go and read through it. And if you need to find out more, feel free to ask in the Telegram group or simply just go and ask ChatGPT, okay? This is what I do actually when I prepare for this. Not everything I could understand. I'm not trained in accounts. Actually, I am in business school, okay? I'm trained, but not to that extent. But you get the idea. We continuously ask. So these are the current liabilities. So they have to pay within 12 months, and the long-term liabilities. All in all, in short, they owe $161 billion. Okay, they have assets of 252 billion. They own 161 billion. So this is the amount that shareholders have. And it's broken down into like a few portions, like treasury stocks. They don't really have treasury stocks. Treasury stocks, sometimes they do shares buyback and they keep the shares. Okay. Retained earnings. Okay, this is very important. Retained earnings means the profit that Walmart made this year. Okay. They made this year and they do not pay out in dividends. This is the amount of money they make. They don't pay out in dividends. It becomes part of our equities, which is our net worth. Okay. Remember when we go back to the first slide, or we talk about whatever assets that we have, including the cash is becoming more and more because we are making more and more money. All these are assets. We have to pay back all the liabilities. So the remaining is our net worth or our equities. So these retained earnings add up to our net worth. Every year you make more money, your net worth increase. If you start to lose money, your net worth decrease. So retained earnings, very, very important aspects of it. And we can see total equity, it is this amount. Now, we do have to actually take away, okay, or account for this thing called minority interest. So what this means is, example, the example I gave just now is we bought a petrol station, but we didn't buy 100% of the petrol station. We bought maybe 80% of the petrol station. 20% still belongs to that shareholder. So we need to account for the fact that when we count the whole entire revenue, or let's say the whole worth of the petrol station, 20% doesn't belong to us. So we got to do some accounting to make sure that it is accurate. Okay, so these are the key things of the balance sheet. Now, I will share with you why balance sheet is so important. Okay, even equity, we talk about all these things. Now, why is balance sheet so important? It's because balance sheet helps us make very strong, I would say, valuation cases. So let me give you some example. There's this gentleman, Kin Wai. He invested in an undervalued Hong Kong company using conservative net asset valuation. Now, what is this CNAV? Conservative, conservative net. Okay, I always thought that CNAV is current net asset valuation. Okay, but he called it conservative net asset valuation, and he made 44%. And you can see that applying, okay, net current and NCAV, okay, which is net current asset value. All these methods, right, has been proven to be very successful. Let me give you some key examples. Okay, so the whole key example of using all these valuation method, right, works like this. So we can see after we have this total equity, another term for total equity is book value. Okay, tangible book value, and also book value. So you can see all these, right? You look at book value per share. When you look at book value per share, right, again, what is book value? Book value is the money that belongs to shareholders. So in case the company goes bust, okay, not say goes bust, but liquidate, they have to sell away all their assets, pay back all their liabilities, and remaining amount they pay back to the shareholders. So in short, if they pay back to the shareholders, how much are they paying back? You can use book value per share as an example, okay, as a benchmark, which will be about $10.41. So if let's say you own one share of Walmart and Walmart closes down, after selling away everything, they pay back everything, they will give us back about $10. Don't forget, there are some portions that's called goodwill. Okay, how are you going to pay that back to us? Well, maybe goodwill, they can also monetize, they can sell it off. But that one, yes and no. So another more conservative way is to look at tangible book value per share. So we are going to get back about $6. This should be quite accurate. Another more conservative method, they look at only current assets. Okay, they take current assets and see how much money they get back, because properties, well, may take a long time. So this is a valuation method. If let's say the company right now goes bust, I can get back about $6. Now, let me give you another example, okay, of let's say Citigroup. Okay, Citigroup, okay, we go to the balance sheet, we go to the annual amount, and we look here. Now, you can see that for Citigroup, the tangible book value, okay, or rather, the book value per share is $101. And the tangible book value per share is $89. Now, remember these two numbers, because what I'm going to show is this Citigroup stock price. Right now, you can buy Citigroup at $79.61. Hey, think about it, okay? If Citigroup closes down right now, you are likely to get back about $89. Okay? Well, if let's say they are able to monetize their goodwill and intangibles, you can get back $101. But right now, you're only paying $79. That's $10 below the tangible book value. And you guess what? The bank, most of their asset is in cash. So is this a strong idea for valuation? Well, obviously, that's if Citibank closes down. Now, and one thing that we like to take a look at is, right, I also like to really strongly like to focus on this thing when I look at this valuation method, which is whether their book value is growing. Because if their book value is not growing, then it's not a good idea because they're losing money every year. Then you may not want to invest in this company. So, example for Citibank, okay, now you're looking from left to right, 2016 all the way to 2023. Book value per share from $74 to 70 all the way to $98. So you can see the book value is growing pretty steadily. The price now is $79. Okay, so good idea, correct? I mean, good idea in terms of valuation. Again, not a recommendation to buy or sell. And I will share with you that this method, right, has been proven for many, many years and proven by a lot of research, a lot of fund houses. So this is a study done by Tweeny Brownie. Did I pronounce it correctly? Okay. But the key thing is this: you can read this paper. Is what has worked in investing by Brownie and Tweedy Brownie. Okay. If I pronounce wrongly, please pardon me. And I want to share with you some of the key ideas. So they have done research where they take all the S&P 500 companies, they break them down into different percentiles. Okay, so some companies they have 30 to 0% of their book value. Okay, so what it means is the price. The price, example, if let's say the book value per share, okay, every single share, the book value is $100. Okay, is it similar to Citigroup? I remember Citigroup was about $100, right? So let me explain to you this again. So if let's say you take a look at the balance sheet, assuming let's say they found a company, the book value per share is $100. Okay, around 100. Right now, imagine you can buy it at $30. Okay, so that's what it means in this study where they say 30% of the book value. So you can buy $30, 30% of the book value. Okay, you can buy let's say 40 to 30%, 50. So they group these stocks into the price to book value. So if the price is 30% of the book value is here, if it's 40% of the book value is here, up to 100%, 120, 140. Anything above that, they are not considering. So they took all these stocks and they invest into this basket of stocks. Every stock that's 30 to 0% of book value, we'll buy it and consider this category. Now, if you buy companies with, let's say, 100% of book value, so example, Citibank right now, it is $100 plus, and you can buy the stocks at about, it should be around this range, right? 100 to 80. Take a look at it. Over the years, 1 year, 2 years, 3 years, compared to S&P 500, S&P 500 make about 8.5%. In 2 years, they make about average is about 18%. In 3 years, they make 27%. If you just invest in companies with about 100% to 80% of book value, you make 15%, which is a lot more than S&P, 34%, and also 51%. Okay, so look at this. If you can buy them at really cheap, really low book value, like 30% of book value, right? You can see that the average returns. Okay, with a high book value, it's about 48%, all the way increasing to about 88%. And you can buy at net current asset value, 66% of net current asset value, which is a Benjamin Graham method, which I'll touch on subsequently in valuation methods. Okay, 66% of it, you can make 87% of returns, average returns. Isn't that pretty good? So this is pretty proven, and it is done years from 1970 to 1981. And they have done even other research like unleveraged companies. Meaning you say companies, you can read here, where their debt to equity is below 20%. So I mean, when it's above 20% debt to equity, it is considered leverage. Now, if you don't understand what's debt to equity, don't worry. I'll be covering this during some of the financial key statements, key financial ratios that we look at when we actually study into companies. So unleveraged companies, very interesting. You can see 30% of the book value is 100 over percent, over 5 years. Okay, no, over 3 years. This is over 3 years. This is over, 3 years. So you can see that this is a very proven method. And do read this article. I'll put the link inside the Telegram as well. And this is very, very interesting. It's very exciting for me because you're buying to a company that is undervalued and it's pretty safe. And remember, if you're buying a company that has increasing income, they are making money year on year, their book value will increase and you can buy below the book value. Well, think about it. That's for you to decide. Okay, it's not a financial advice. So I do hope that this has helped you. In conclusion, balance sheet. It's beautiful. It's one of the beautiful financial statements I like to look at. I mean, I love looking at income statement. Balance sheet. Wow. Completes the picture. Okay, I shouldn't say complete because there's still cash flow statement. Otherwise, you guys won't come next week. Okay. Anyway, it gives us a snapshot in time of what we are actually buying in terms of assets and liabilities. And it's essential for valuation in value investing. So what's your homework? Your homework is to study the balance sheet of the companies you want to own. And also you can ask questions in the Telegram. So how do you study the balance sheet? Go to jita.com, or you can go to the financial statements of the company and go and study them. Go and look through them. Go and see what you're buying. Now, again, one thing I want to add, in relation, all these numbers are very big. Wow, 22 billion, 100 over billion. Again, look at it as a trend. Has it been growing? So that's why I like to look at example, where's this Citigroup. Let's look at Walmart again. So in Walmart, all in all, after looking through the balance sheet, I like to go to fact sheet. Okay, fact sheet gives you 10-year results. Example, book value per share. So you can see book value per share of Walmart from $8 growing all the way to $10. It is pretty slow though. Every year is growing by 1-2%. As compared to Citigroup, well, they are growing a little bit faster. So I do hope this helps you guys. Hope that you have improved yourself in terms of your knowledge in investing university. I'll see you guys next week. Remember, after doing all this, you got to be diligent. The plans of the diligent leads to profits, leads to abundance. And also remember, sizing is everything. Position size, make sure you diversify your risk and make sure that you really keep safe. And remember, money is not everything. Money is just part of the resources to help us reach our goal and to be a good steward. I'll see you guys next week.